Thank you everyone for joining us today. Today we'll be talking about structuring the right SPAC transaction for all parties. I'm joined by Adam Kurbis, Managing Director, Head of SPAC Investment Banking at EF Hutton, Henry Regano, Senior Investment Associate at Meteora Capital, and Anthony Zangrillo, Shareholder Capital Markets at Greenberg Traurig. I'm Nolan Manafo, Director on the Investment Banking team at EF Hutton, and I'll be moderating today's panel. So we'll jump right into it. Adam, what trends are you noticing in the market regarding deal size, total proceeds, use of proceeds, and how does that compare to prior cycles?
Yeah, thanks, Nolan. I'll give a quick intro first before I dive into that. So Adam Kurbis, Managing Director, Head of SPAC Investment Banking at EF Hutton, came here after 5 years at UBS, 6 years at Early Bird Capital and Cantor. So been around this product for a little while, have seen the different trends. And so the main trend I would say we have right now, and not to be too flippant about it, but I think we are back to normal. And normal to me is pre-2020. So what that means is sizes of deals that are in the 200 in the IPO range, and that means merger sizes of sub 1 billion typically. I think that's important for a couple of reasons. Number one, it's more achievable to do deals like that. But number two, when you have sort of a more crazy market or a dead market, you end up with deals that don't really work for anyone. So for example, I think I would say when you see SPAC deals above 5 or 10 billion of valuation, you end up getting those companies that may or may not be prepared to be public. They may not have the IPO path available, and so they're choosing this path as sort of a last resort. And I don't think I've seen that, quite frankly, in a few years. So to summarize, I think we're in a really good place. We're seeing a lot of deal flow here at EF Hutton, and honestly, all what I would call very high quality.
Henry, do you want to give a quick intro on yourself and touch on that topic?
Yeah, absolutely. So my name is Henry Regano. I'm a Senior Investment Associate at Meteora Capital. It's an investment firm that specializes in SPAC investments. We do every aspect of SPAC investing from A through Z, so that means risk capital, SPAC IPOs, secondary trading of the SPAC securities, and also the de-SPAC investments in the back end, both equity and debt. Obviously, I agree with everything that Adam said. For me, one encouraging trend is seeing more and more repeat sponsors coming to the market, especially ones that have experience in a prior cycle. What I'm seeing even more recently is some sponsors that might have done a transaction in 2020 or 2021 took a few years off because they learned very valuable lessons from some of the difficulties that they previously had, and now in the new environment, they're coming back in with those lessons learned to execute an even better transaction than they did previously, and I find that very encouraging.
Thanks, Henry. Anthony?
Hi, Anthony Zangrillo, shareholder at Greenberg Traurig. I've probably been practicing for about a decade, focusing on SPACs, de-SPACs, IPOs, and private placements. I'm really excited to be part of this panel. I would say the honest truth of what I see in the trends in the market is you saw, let's say, in the SPAC boom in the past, there was a lot of big announcements and big numbers on how much cash would be provided at closing, but then all of a sudden, either the deal didn't close or that money wasn't provided, whether that be because of redemptions or because of some other reason on the pipe, transaction. Now, there's really a big focus on discipline and making sure that the cash actually ends up on the balance sheet to the company at the close of the de-SPAC. And I think that's really key to everything that we're seeing, so that when these companies actually go public, they're not just relying on, now I'm a public company, they have the assets and the cash on hand in order to thrive as a public company. I think a lot of what we're seeing, even in the SPAC IPOs, is serial SPAC sponsors, dedicated teams, not as much of the celebrity SPAC as was done in the past. And I'm really excited about where the product's going to be going in the next couple of years.
Thanks, Anthony. That's a great segue into our next topic, which is about the private companies. What do you guys think the private companies should be focused on in their initial negotiations with a SPAC sponsor? What are the key variables of a SPAC sponsor selection?
I can kick it off. So we were told there'd be some private companies in the audience, so we felt it was important to address this question. So when it comes to SPAC sponsor selection and the SPAC merger process, it's a little bit of a two-way interview between the sponsor and that private company. For me, the three main variables comes down to the sponsor experience, whether they've done this before. And I add that because the SPAC process can be a little bit niche and specific, so the prior experience is always very helpful. And then there's cash dilution, meaning the cash expenses, and the share dilution as well. And obviously both of those things, depending on what it is, can be negotiated to a certain extent. I always tell private companies if they can control those three things, it's usually a good start for the structuring process.
Thanks, Henry. Adam, anything to add?
Yeah, I'll jump in and agree with everything Henry said in terms of the actual structuring and the technicalities between creating a deal that is not overly dilutive and actually makes sense. What I would say in addition is that the most important thing to do is make sure that you are able to find the right sponsor that can really bring you something besides a shell. And I say that today, that wasn't always the case. There were times where every SPAC, in a way, was somewhat equivalent. They all were a shell to go public, and there's nothing wrong with that. But a lot of those deals had trouble, at least in my opinion, making companies that could survive publicly. And so that wasn't really the best market to go public. It worked. Some companies years later have done great by doing those shell mergers. But I view it more so as important to find a sponsor that can help you as a sponsor, which might mean they join your board. That might mean they have unique and proprietary investor connections. And I think, at least in my opinion, a very underrated aspect of which SPAC to choose is which banking partners they can bring on. We all know investment banks can be very helpful if they'll work with you, but investment banks are very careful with who they work with. So I think the number one thing there is making sure you have the right partners on all aspects of the deal.
Thanks, Adam. So staying on this topic, what do you guys think a private company can do before it even ever meets a SPAC to make itself a more attractive business combination partner in terms of financials, governance, growth story, or deal readiness?
Sure. So this goes to my point about the process being really a two-way street. So I think a private company needs to do the best that they can to project out what their needs are in that SPAC merger process and try to anticipate some of these work streams early so that you present better to that SPAC sponsor and you're more attractive to them as that merger target. So the two very important things, in my opinion, would be having the financial audits done and also not having any dire immediate cash need. I spend a lot of my time talking to private companies on a day-to-day basis because as part of my investment role in Meteora, we also sponsor SPACs, so we're also a SPAC sponsor. And it's very discouraging to me when I meet a private company whose immediate goal is to raise a significant amount of capital just to stay solvent before even beginning to entertain the SPAC process, and also has not even interviewed different auditors or kicked off that process. The reason why I focus on the audited financials, because sometimes I hear from the target side that they do have financials, why does it need to be audited, is because you need those eventually to file the S4 or the F4 merger proxy for the transaction. If you don't have that, you're able to work on other things, such as the background section and the risk factors and the merger structure, which you would hope that the SPAC sponsor takes. But without the audited financials, you won't be able to file, and you won't be able to show the market meaningful progress in that transaction. And of course, SPACs have a finite life. So my advice to private companies, even before meeting sponsors, is at the very least, kick off the process for the audits and try your best to solve for any near-term immediate cash needs.
Thanks, Henry. Anthony?
I would echo that sentiment completely, that I think the biggest thing is the audited financials. Having a PCAOB audit. We've done a transaction recently where that was already completed during the negotiation of the BCA, and we were able to get the registration statement on file within, I think it was 2 weeks after signing, and it just made it so easy to close that transaction because we weren't waiting for months to get the audit done. The biggest advice that I give private companies that want to be a really, valuable target to a SPAC is a company that is basically operating like a public company even while it's private. If you have everything ready when the lights are on you, let's say I give an example. You want to be Wembanyama in Madison Square Garden last night. That's what we really are looking for here. That when all the optics are on you, can you perform in the public markets? When you already have everything ready to go for years in the private world, it will work when you actually go through the de-SPAC transaction.
Thanks, Anthony. Adam, would you like to round it out?
I would. I'll be a little bit biased, but I would say to be ready to meet SPACs, I would highly suggest target companies have a banking partner of some kind. I think that when you're meeting these SPACs, there are various that may or may not be a good fit. Your best chance of beating a SPAC that will be a good fit is having a bank ready with you, building out your story, your investor presentation, helping your financials be presentable to a SPAC. It is not something that most entrepreneurs or most businesses can do off the cuff because their job is to build their business, not to meet SPACs or investment banks. I would heavily suggest private companies get a banking partner and get ready because you really have one chance for a first impression. And what you do not want is to meet your 5 or 10 best fit SPACs and they think you're not ready.
Thanks, Adam. Changing gears a bit, how do you think about valuation in the context of a de-SPAC? Pre-money, post-money enterprise value, IPO discount, earnouts. What are you trying to accomplish?
Yeah, I'll hit on that for a minute or two. I think what's important is to understand how valuation works to the market. So I've seen many companies negotiate a pre-money valuation and sort of ignore the enterprise value to the market. And without getting too technical, you really need to make sure you negotiate both because your pre-money valuation, while that is your equity you're rolling over, there can be significant dilution outside of that, as Henry alluded to earlier. So for example, I was working on a tech deal about 6 months ago, and this particular company negotiated a pre-money valuation of around 500, not paying attention to the fact that including deal expenses, which were very high, and including an amount of, quite frankly, sponsor shares from a way too large SPAC, you ended up with a valuation to the market of 700. And that obviously that's a significant percentage increase. But as well as the multiple, this was a 100 or so revenue business. You're going from 5 times, which is perhaps fair, perhaps not, to 7 times, which made it undoable. And that is something that we ended up marketing for a while. It did not work out. And quite frankly, I think the reason is that the valuation expectations were set sort of independently from the structure, which again led to a significantly higher valuation than was intended.
Thanks. Henry or Anthony, anything you want to touch on from the valuation perspective?
Yeah, and look, I see this all the time. One of the benefits of a SPAC transaction is you're able to structure the merger privately before you announce it to the market. But that's sort of the issue as well, because some of these transactions are done with external market support, where they'll include some sort of a pipe as part of the business combination announcement. And that investment, if done at the deal valuation with no bells and whistles, validates that valuation. But most transactions that are announced in the SPAC market, unfortunately, don't have any capital that's tied to the deal announcement or don't have a clean $10 equity pipe tied to the deal announcement. So what I see, and it's very related to what Adam just said, the valuation is set privately without thinking about market reception in any meaningful way. But once it's been negotiated and valued and agreed to by these parties, sometimes it's hard to change the psychology of these players for them to understand that the market just seems to disagree with that valuation, and everything has to be done in a balance between setting the valuation that you want versus raising the capital against that valuation. These are two distinct concepts.
That's a great point. Thank you, Henry. Now, how should deal teams think about the correct advisors? How do you think about size of the deal, intent of the deal, et cetera, and how that can affect the advisors that you choose? Anthony, if you want to start.
Sure. So I really think about with the advisors, you want to really get everybody on the same page early on, whether that be a kickoff call or you're just even over email, you want everybody having the same consistent message. And I would say back in the old SPAC boom days, sometimes you would bring the IR team on like the weekend before deal announcement. That is not good. It's not just to put a PR up or anything like that. You really want everybody working with the same story and, even the lawyers understanding in the disclosure what is the merits of this deal, what are the risks, and what do we need to include in the registration statement. Everything works together. So I think it's really important understanding what type of deal, specifically size, and then also understanding who are the advisors. One thing that I've noticed, sometimes let's say when you have an M&A advisor versus a capital markets advisor versus the placement agent, you want to really think about who is the right, person, bank for that role, rather than just thinking it's a one-size-fits-all.
Thanks, Anthony. Henry?
For me, something that's very valuable is having advisors on the other side that are very realistic and are willing to have those hard conversations with their clients. And I can tell who is who just based on the vibe in the conversation when I speak to either the SPAC sponsor or the target. And I can tell which advisors are advising their clients about the realities of the market and which are being overly polite and allowing their client to try something that's just unrealistic and quite frankly a non-starter. It's a challenge for me because then I might have to end up having that harder conversation, and then I look like I don't like the deal, or I'm rejecting whatever their business is, which is just not the case. It might be that something showed up in my shore, so to speak, and it's already a non-starter.
Adam?
Yeah, I'll jump in and I'll tackle this from the SPAC IPO and the D-SPAC, which are both obviously completely distinct but often linked. So I think a mistake that some SPACs make is they bring on an IPO underwriter who is not an exact fit for their needs. So to use an example, and I won't go by name, but to use an example, there are certain banks where their expertise is underwriting but not advising on the D-SPAC. There are obviously vice versa. There are certain teams, and it's really most SPAC teams in my opinion, that need that hand-holding the entire time. They need the market updates, they need the understanding of how to approach targets, they need help raising capital eventually. And if you are that type of SPAC, then I wouldn't suggest a SPAC advisory firm that does not do that. There are some bulge brackets that do all, there are some that do not do the whole thing. There are boutiques that are different, but I would, again, make sure when you're hiring someone, make sure you know what they do. I could say the same thing about law firms. Some law firms will tell you, we're willing to go through the prospectus, but if you have to negotiate side agreements about financings, we don't specialize in that, and so we won't be helpful. And that's completely honest if they say that. But I would make sure you are hiring people that are doing what you think they're going to do. Conversely, I have seen deals where they are trying to raise hundreds and hundreds of millions of PIPE or other. They are trying to add a valuation of several billion. They might be on file to IPO, but this is really an IPO alternative. And for a deal like that, it might make sense to look at some of the bulge brackets with a 10 or 20 minimum fee, but it usually doesn't. It usually do want the flexibility. You usually want a boutique bank that might charge you a lot if they do a great job, and they might not otherwise. But you have to make sure, at least in my opinion, that you are meeting the advisors that are going to do what they say they do, that will help you when you need it, and will back away when you need it. And to give one more sort of example there, during the SPAC boom, there are many SPACs that had worked with large banks, and many large banks who walked away due to regulatory risk. And many of those SPAC teams had paid several millions to those large banks, and in fact actually owed an additional deferred amount of fee to those banks. And I would say 75% of those situations did not end up in the right place. So again, I would pay very careful attention while you're hiring a partner. Make sure they are going to do what you need them to do, and get that in writing. Get the bank to say, I will help you even after your IPO. I will help you on your D-SPAC. I will provide help with a PIPE if I can. I will be your capital markets and or financial advisor, and just make sure that all parties are actually doing what you need.
Thanks, Adam. Switching gears to Anthony a bit here. What legal or regulatory issues need to be considered early in the process to make sure the transaction is actually executable, marketable, and defensible to investors?
Yeah, and it's really a lot that you have to consider, every time you start one of these transactions. And I think you really want to get up to speed on the Securities Act, everything with what do we need to disclose in the transaction, through the diligence. Is there anything that we need to be extra cautious about in how we disclose this to the public to make sure we're not missing anything? The biggest thing when I start a lot of these processes when I'm representing a target is looking at the cap table and just understanding who is a current investor in the private company. Are there any rights that could be a complication in this deal? And we have to disclose those in the registration statement, but just understanding, was there prior financing rounds? What type of instruments were used? And dovetailing with that, when you're looking to raise capital, what type of capital are you raising? Right now, it's a very structure-heavy PIPE market, as I would say. And, we see term sheets sometimes where I have to have a tough conversation with the SPAC or the target, basically saying there's a cost to this capital. Some terms in it could basically cause a debt spiral for a de-SPAC company after it goes public because it's not able to meet certain metrics that are put in the term sheet. So it's really just understanding not all capital is the same and working, through the regulatory guidance in terms of what do you have to disclose to the market, as well as understanding, let's say, some structures don't work under NASDAQ due to different limitations. I also think the other thing that I just keep emphasizing is those financials, of just understanding not all audits are the same. So an audit that you did when you were a private company is not the same as a PCAOB standard. And the earlier that you start having those conversations with the correct auditor, the quicker you can complete the transaction.
And I'll say something else because you said about NASDAQ, Anthony. One of the big things is meeting the listing requirements in the back end. And particularly for me, the float requirement, having a certain number of fully registered, unrestricted shares that are not held by affiliates, not held by insiders or beneficial owners. You have to think about that before filing the first S4 or the F4, because to the extent that you need certain shares registered in that registration statement or have it in the hands of certain holders, or you need to do a particular small financing prior to the filing of that proxy statement so that you can include those shares for registration, you have to do that before. That means between the signing of the business combination agreement and the filing of the S4. If you get to the end and you have a deficiency and you don't have enough shares, it can be a little bit difficult to release certain parties from lockups, to raise capital at that point. You can't go back retroactively and register shares. It can become a little bit of a mosaic.
Yeah, and I know one thing, sometimes we do a warrant exchange, right, to meet those requirements. So you have that meeting basically the same time as the shareholder meeting. I will say what was interesting with sometimes meeting, let's say like the round lot holder requirement, rights have helped a lot, although there's a cost, dilution day one to the company, but it does help guarantee listing certainty a little bit.
Yeah, I'll add just a couple of things. I want to touch on rights versus warrants, as well as just being better prepared to actually go public. And what I advise every party to do is to be as transparent and honest as you can as soon as possible. That's a little bit underrated sometimes. I have found literally several billion-dollar companies not sharing the fact that they're about to get a settlement of $2 million that means nothing. It's not even something that would have to be in the filing, but just be transparent about that, because when that comes up on a diligence call the Sunday before a Monday announcement, the deal isn't happening. And that is obviously never a good thing. You don't want to delay any deals by any amount of time. You have your IR ready. You have everything ready to go. So it's just being transparent as soon as you can is absolutely the most important thing to get these deals done from a banker's perspective. And I would add one more thing on the rights versus warrants, because Anthony and Henry brought up a good point. On the rights, obviously they are downside dilutive, upside less dilutive, and opposite of the warrants. I think that's something that a lot of targets have trouble learning and sort of understanding. And so what I would at least say is that the warrants and the associated dilution is not necessarily as negative as one would think. If you actually do the treasury stock math on these warrants, you end up with a much lower dilution level unless the stock performs amazingly well than you think. And so I think the right structure is a really good, it's always been around, but it's sort of a good innovation in that it's come back and become more popular. It's helping with listing requirements, it's helping with liquidity, it's helping with float, and it's helping with everything except the fact that it does end up dilutive even if the share price goes down significantly. And sometimes that feels like a double negative, which is not a good thing in the SPAC world. But I always do say, make sure you are modeling out the $1 share price, the $50 share price, and comparing the rights and warrants in both of those scenarios.
Thanks, Adam. As we've discussed, many current SPAC transactions require more creative capital solutions to address redemptions, closing certainty, and post-closing liquidity. When those financing features are added to a deal, how should deal teams think about the legal, disclosure, governance, and investor relations consequences?
Sure, I can kick us off. So this actually related to my point earlier about having the valuation be realistic in the balance of raising capital. You can't have an unrealistic valuation and also raise capital at the same time. So there's different ways to structure that capital into the deal. The first is the plain vanilla pipe at $10. If you get investor reception there, that means that you likely have a phenomenal deal because investors expect that your business combination is worth more than 10. That's why they're investing at 10. If you can't get that, then the simplest thing to do would be a very modest discount, giving investors a little bit of extra coverage of free shares to get them down to, let's say, $9 or something relatively inoffensive there. And if you do something like that, I would argue that the market reception is not necessarily negative, especially if those parties are making the commitment several months before the closing of the business combination, and they're taking the market risk between the deal announcement and the closing. It's something that's very understandable for that modest discount. But if you can't get that modest discount, then you will need to either go into a deeper discount or add warrants as additional equity upside to investors. And I use that as a little bit of a catch-all term because there's different kinds of warrants. Some have very aggressive resetting features, some are just plain vanilla. But these are the things that you might have to do. Now, to be realistic, if you hypothetically have a transaction where you're selling equity at $5, giving warrants on top, and the warrants can be reset down to $2, the market will not see your business combination at $10. Something that you could consider doing, and obviously I understand that there's pressures on both sides of the table, is cutting the deal valuation to make it more realistic at that point. Because in my opinion, there's not a lot of value in maintaining the valuation at that $10 a share. Meanwhile, you're selling equity between 2 and 5. It just doesn't look good. Now, for guidance on market reception and what investors think about the deal, you can look at both the rights and the warrants. So the rights are the simplest. They trade on an implied price of how the market views your business combination following the closing. So if hypothetically the rights trading at 40 cents and there's 1/10 coverage, that means that the market values the implied price at $4. You can do something similar with the warrants by using a Black-Scholes valuation and back solving for the implied share price. But by far the best source of feedback would be hiring a very effective advisor, like what Adam was highlighting earlier, and going through a diligent wall crossing and pipe process to get that direct investor feedback directly from the investors.
Yeah,
Thanks,
I'll
Henry.
hit on something with the creative capital solutions, which are often needed and they're extremely helpful. I think the number one thing that should be done, and Henry and I have worked on many deals together, it's actually just being transparent. So if Henry were to call me up and say, look, the valuation is significantly too high. In our opinion, it is 50% too high, 100% or 90% too high, whatever it is. Let's talk, let's figure it out. And if Henry says to me, I'm sending you a term sheet, it has bells and whistles, which make it such that I make money, even if this goes down to what I've calculated as an appropriate valuation, that's okay. It's just being transparent. Because I have worked on deals where that has not happened. A certain investor says, hey, here's my term sheet, love your deal, please let's work together. And it has things in the term sheet that are just not really feasible for a company to keep on their balance sheet or keep in their capital structure going forward. So I'm kind of a broken record on this, but transparency and honesty is really what you need to make sure these things don't blow up at the last minute.
And what's interesting with that, if you look at the background section, a lot of registration statements, you see that investors are usually the reason why valuations decline. That there's a whole negotiation back and forth. And I think sometimes the staff is in disbelief on that, but it happens a lot.
Good point. All right, so how should parties in a cross-border foreign private issuer SPAC transaction be thinking about a post-closing capital markets profile of the combined company, particularly in light of proposed SEC shelf registration reforms?
So this is really interesting because the proposed rules are a welcome, addition that it's going to make it really easy, or I suppose easier, in the current proposed form state for the de-SPAC companies to access capital quicker by decreasing that timeline and when you can use the shelf registration statement rather than long form S1. What is it? I wouldn't say unintended consequence because it could be intended by the makers of the legislation, is it does, put foreign companies, foreign private issuers at a disadvantage. Normally, when we make these transactions, I always like to think it's driven more by tax considerations when you have like a foreign private issuer, but there is also some reporting accommodations. It's easier in terms of, let's say, it's like a 6-month instead of every quarter that you're reporting. Now, there's an actual severe disadvantage, I would say, because the foreign private issuers have to stick on the old Form 3 rules that it would not be that they can use the shelf registration statement immediately. So I would think when you're making this transaction, you're thinking of the structuring, there has to be a discussion at some point that when the rules are in effect, you would have an advantage being a domestic issuer versus a foreign private issuer. And we'll see. I do believe there have been some comments that have been submitted, on this, and I don't know how the staff is actually going to respond on that. But it's something just to keep on everybody's radar on the final rules.
I'll say the proposed rules, I think, are very good for investors in the overall market because it's going to reduce the cost of capital and the capital friction that go with these investments. But as an investor, it's going to make it easier for us to put money in because if you can do your investment on a fully registered basis where literally the next day the investment is live, registered, and tradable, of course it's going to be easier to underwrite that company. You're going to be more compelled to make that investment, and that cost of capital, therefore, is going to be cheaper. So it's something that I think a lot of investors are welcoming.
Do you think the pipe market is going to come back quicker? Because let's say when a transaction closes, these rules should be in effect in theory. So it's almost like I don't think I would wait for the rules to come into effect, that I would be thinking about it like almost like game planning for that a little bit.
Oh, for sure. I mean, we already are. So, I mean, we're already coming up now with a long list of companies that we think are suitable candidates, if not for that registration lag in making the investment. So, I mean, we're watching those rules very closely. Should they come into effect, and we'll be proposing term sheets right away.
Perfect.
I'll touch on one more topic. This comes up a lot for all of us in the SPAC world. And it's the fact that many de-SPACs have not traded above deal price, and many have traded significantly below. And I think it's a very important piece of this panel because what we've been talking about is making a deal that works for all parties. There are usually three parties in a de-SPAC, three involved parties, which is the company, the SPAC, and the investors. There have been many deals, which Henry hinted at, which don't have investors, and there's absolutely nothing wrong with that. There were deals in 2023, many of which were structured in a certain way such that investors were not involved, but rather these were two-party transactions between a SPAC and a target. And to make these make sense for the target, because the target was not raising capital, they had to do something to get rid of dilution. And so what many of these deals did, which is completely allowable and completely legal, is they raised the valuation to a level which was significantly higher than what they believed was accurate. So for example, they believed they were worth $1 billion, let's go out at $5 billion, because that's a legal way to flush away a lot of dilution. It gets rid of the warrants because the warrants are that much more out of the money, and it gets rid of the promote shares because they're also struck at $10. So quite frankly, it was a fair way for a SPAC and a target to two-way negotiate and make sure that the deal made sense for all parties involved, again, without investors. I did say, and it is my belief, that a stronger type of SPAC transaction does include investors and therefore should be a three-way negotiation. But again, there's absolutely nothing wrong with using a SPAC as a shell merger without raising capital. And that has been done many times over the years.
Thanks, Adam. Now we have just about a couple minutes left, but we wanted to open it up to the crowd if there were any particular questions that anyone had.
Sure. Yeah, I can hit on that quickly. I know we only have about a minute left. What I would say is I completely agree. Any transaction which raises capital for a small or medium-sized private company is a good transaction. In all honesty, if you're trying to do private raises, which I think many of us here do try to do, a private raise is difficult to do. A private raise comes with things that are not necessarily obvious dilution, but bells and whistles, which can be more dilutive. And I've never told a company that is smaller or private, or I'll stop saying small, a private company, I've never told one say no to 20, 30, 40, 50 bucks. It basically doesn't matter the terms, because unless the founder has a $20 million check to put into the company, you should take the capital however you can get it.
And to your point, sir, I mean, what I'm talking about, this market really opens up when you're public. And if somebody comes to that company's door and offers them a certain amount of capital, they get to name the price. The company doesn't have to take it, but it might actually be a very good idea to take it, provided that it's enough capital, for sure. Right. So the rights are already outstanding. That's the key thing. They're not being created by people purchasing them. They're registered as part of the SPAC IPO. So that dilution is already baked in. The person that holds them, it's really fungible. If I'm holding a right and I sell it to somebody else, that's a secondary transaction. The company receives no proceeds. My point about the rights earlier is that it can be a distraction in that capital raising process because investors will bake in that dilution. That's the first point. But secondly, they will of course consider the price of these rights, because if you buy the rights at a certain ratio, let's say it's a ratio of 10 and they're trading at 20 cents. If you buy 10 of them, you'll spend $2 and you'll receive 1 share. That's a way for you to get a fully registered share of that company at $2. So it's a public security, we all see it. It can be hard talking to that issuer and have that issuer ask for anything greater than $2, knowing that I can just go buy this public security.
I'll reiterate, your advisor should be calculating the associated dilution from rights or warrants if you're down 90% or up 10 times. You want all scenarios to be accounted for.
William?
Yeah, so post 21, which was an unusual market for everything public, SPAC or IPO or anything else. A good SPAC today, I wouldn't put a size on it. I would say the lowest you should see is 100 these days. The highest you probably are seeing is 500, but typically less. But what I think is more important is having the right advisors of all kinds and really the right deal flow to put together a deal that's going to be positive. And on top of that, you need a SPAC that can bring together capital on top of an investment bank. Not all can. It is extremely useful to market a pipe when you can say, we, my friends and family, have put in 5 million, 10 million, 15 million. And it's very challenging, depending on the company, without. There have been many SPACs the last year or so that have raised significantly in excess of 100 or 200 million, but many of those did have sort of an anchor from a known party.
Perfect. Thank you. I think that leaves us out of time, so wanted to thank you all for listening, and we'll turn it over to the next panel now.